If you want to know what's happening in the economy, you don't have to be confused. You don't have to have a big question mark. You just have to watch this. You came here for the truth, so let me unveil that for you. If you've been watching this channel for a while, you understand the money mirror method. If you're part of my Finance Friday class, you hear me talking about it every single week. Money mirror method. The people who are new to the channel, you might not know, we're going to explain that today. What it means for you is that if you watch this, if you look at this indicator, you're going to understand what happens in the market before everybody else does. How can I confidently say that? Because it's been going on since 2009, highly accurate. And I'm going to show you different ways at which we can look at it, but overall, understand that you just need to look at this and you will see things before they happen. It's wild, it's crazy. No soothsayer talk, but I'm telling you, it's real. So here we go. Fed liquidity versus assets, and you will see the recent divergence which has happened, and it shows us the blue line, which is Fed net liquidity compared with Fed total assets. And what we are seeing with this is basically the Fed's balance sheet, how much stuff the Federal Reserve has compared with net liquidity. And you might be asking, what is net liquidity? But just for a second, stick with me, okay? If you have seen over the past few years, it's been very clear. When the Fed prints money, when central banks devalue the currency, we do see a correlation in between that, the amount that they're pumping in, as well as the stock market. Pump more money in, stock market goes higher. But it's been weird, right? Because the stock market is back to all-time highs, and yet the Federal Reserve has reduced their balance sheet quite a bit. And interest rates are still at these high levels. So you might ask yourself, well, something's broken with your equation. Something's not working there because we are not in the position that we were before. We're not at 0% interest rates. We are not in the middle of quantitative easing. So your methodology is not correct. But of course, the money mirror method doesn't fail. The money mirror method is something that I didn't necessarily develop in that sense, but I just quantified it all, looked at it, and have been going back in history and started to make sense of it all. It's a tedious task, but that's what I'm here for you to basically to look at when you watch my channel. You're saving time. Here we go. This is it. What we can see from this is the indicator, which is known as Fed net liquidity. You know, there's a number of different ways to look at it, but you see the correlation here. Fed net liquidity versus the S&P 500. It's perfect. It's virtually perfect. Looking at this, it's an indicator introduced by Max Anderson, serving a valuable tool for forecasting market trends and identifying short selling opportunities. This indicator is computed by the Federal Reserve's balance sheet. Then you look at the Treasury General Account and then the reverse repos, offering insights into the actual funds available for circulation within the economy. This is what we do. We give an update every single week on the Finance Friday class, live class. They're already aware of this. They're right now they're bored of what we're talking about because we look at it every week. But this is the type of thing that makes a lot of sense only when you know to look at it. And you say, oh, I see the correlation. Of course, there's more to it than that, but that's like the core of it. That's a lot of it. And when you track it every single week, and then you do see divergences, like look at November. No, that's not working. That's not right. But you see it and it eventually makes it back to where it was before. It amazes you over and over and over again. So what can we take from this? Well, it's that if you understand Fed net liquidity, or what I call the money mirror method, this is the way that we can predict what happens. And there will be times in which it diverges. But as long as we understand that we got to go back to this, back to it again and again, week after week after week, because it's not a daily thing. And like I said, it's going to get a little messed up sometimes. But in general, where the liquidity is, that's where the stock market is. And for some people, they just can't get, no, it's what's going on in the Red Sea. It's what's going on with the oil prices. It's what's happening in Russia. It's not what you're saying. And, you can suggest one way, shape, or form, but I'm telling you, this stuff is highly accurate. Looking at it, you've got a problem here. Currently, as it stands right now, the Federal Reserve has increased interest rates, and that has affected you with your mortgage rates and credit cards and everything else, but it has also affected the national debt. And so you can see the US interest expense has exceeded $1 trillion. Wow. I mean, that's unbelievable. That's just interest. That means before your infrastructure is getting paid for, before your healthcare, before everything that's essential, they're putting money, your tax dollars, into interest, something fictional, something that was created out of thin air. And yet that's where the money goes. It will get paid. Your healthcare? Sorry, don't have enough money. This is the way it goes. And so we know that at this time, they're still paying that up, but at some point, they're going to feel that pressure. The pressure builds. And I believe they want to cut interest rates in order to ease this burden. But I mean, you grow debt to a certain point. It doesn't matter if the interest rate is low, it's unaffordable, it's not manageable. That's what's going on today. The sheer amount of debt has gotten out of control. Stocks are a popular inflation hedge for future retirees. We asked, how are you protecting your retirement savings from inflation? I'm adding more stocks. And so the risk taking is certainly there. Stocks are seen as a risk asset. Bonds are seen as less risk. And whether you agree or not, that's what's happening here. And so we're going to see more money flowing into stocks. There's no question about that. It will leave fixed income. It will leave bonds. We did see some attractiveness during what happened recently with bonds being more, the interest rates were higher. But now, if they're going to start cutting interest rates, well then, that takes away from that value and more money will go into stocks. So we have to look at all of these things. Net liquidity. Understand net liquidity, okay? The Federal Reserve, Treasury General Account, reverse repos, what's happening on that side. Then we got to look at financial conditions. Financial conditions encompass a whole bunch of things. It depends on which index you're looking at, but you can just say the term broadly, financial conditions. That's kind of the umbrella over top. And knowing where we are with financial conditions gives us a little bit of insight as to, okay, are we going tightening? Are we going loosening? And then we have to understand, where is the money going? There's money everywhere, but where is it going? Some of that today has been leaving China. It's been leaving real estate. It's been leaving the stock market, that's for sure. Trillions of dollars lost in the Chinese stock market. And a lot of that has flown into US stocks, in particular, what they call the Magnificent Seven. The tech stocks. Those are the ones that have become really attractive. They've been fluctuating. Of course, when you get to too high of a level, suddenly they become unattractive. But, we're splitting hairs at this point. And so knowing all of these things and the hundreds and hundreds of others that I collect on this channel, you start to get a bigger and deeper picture of what's going on. So at this time, we could see that despite the Federal Reserve selling off trillions of dollars, they are still in the aggregate, in the total, we can still see so much liquidity pouring in, making up and even exceeding the shortfall created by the Federal Reserve. So in the end here, how much further does it have to fall in total, everything, before that starts to have an impact on the total net liquidity, and then stocks come down as a result? That's what we need to understand. That's what we need to look at. That is what's going on for 2024. And I'm telling you right now, you better get wise to this information. If you're not going to join me in the live classes, then you better check every single week looking at this data to know for yourself. I will do that for you here, but of course, if you're unable to join for whatever reason, then you got to look at this stuff, keep up to date with it, and be more informed than your financial advisor. Be more informed than your friends that believe that they know what they're talking about. There's a reason why I was able to predict the stock market bottom in 2022, October of 2022. I actually told people in September 2022, and here we are today. Okay, I still get the hate every day. I want to thank those haters each and every day. I do appreciate that. Really, I really do, because it keeps me going. This is the live class. Okay, so if you want to get in on that, the link is themoneygps.com/live. There'll be a link in the description, themoneygps.com/live. If you haven't already, hit that thumbs up button, because this is the information you can't get elsewhere. I'm not talking about clicks. I'm not talking about likes. I'm talking about just the information you need to know. If you appreciate that, hit the like button. And of course, I'll see you tomorrow. Take care.